This week, we're reviewing the Cannon Flexible Fund managed by Cannon Asset Managers. The fund was formed in 2011 and it's got a fund size of 119 million rand to date. The objective is to beat the long-term outperformance of the All-Z with the hybrid benchmark applying over the short term, and the TER is set at 1.42%. I'll start with you, Adrian, because of course you're one of the people who've looked at how to form this fund. Just give us an idea of the philosophy that you have behind the Flexible Fund.
So the point that we were just making about asset allocation being the point of departure, that's the point of departure in the management of this portfolio. My colleague Andrew Ditburner runs it, and Andrew's jump-off point is asset allocation to just two asset classes, so it's uncomplicated, and those two asset classes are equities and cash. He can move very aggressively, and I think the word to replace with aggression with is conviction. So he can move with high conviction in big steps between equities and cash.
So percentage weighting between the two?
At the moment, he's about 85% in equities, but the fund has the discretion, or the fund manager has the discretion to move 50 to 100 in equities. So the lowest equity allocation will be 50%, and he can move up from there as he becomes increasingly convinced about the prospects for equities. He can move all the way up to 100.
So it's tactical fund management right now, and being able to actually manage returns based on where prices are, I suppose, in the markets. Cobie, your views on the fact that it's got an 80% weighting to equities right now?
No, I mean, I think that's probably pretty fair relative to kind of where you see the market is at the moment. As a matter of fact, if you look at some of the holdings in the fund, I mean, it's got really decent resource exposure. And that's one of the things a lot of people are kind of shying away from. They're kind of saying, we're not sure about resources because maybe China's going to fall over. Whereas this fund's got ample resource exposure. It's probably slightly lower on the financials, and then got decent industrial exposure as far as that's concerned as well. And I think the issue here, obviously, Samantha, is that, you know, the fund manager can move very aggressively. So he can decide to own, either he can mothball the fund or he can position it for growth. And he can decide relative to the universe that he utilizes. I think the other thing that's also important is it utilizes a quantitative technique in order to kind of ascertain which stocks it's going to own. And that's called the cyclically adjusted or cyclically adjusted price to earnings ratio. Yeah. Maybe just take us a little bit through that and what exactly that means.
At the moment, what we've got going on with markets being sold down is, you know, prices are falling, investors are anxious, and I think there's good reason for near-term anxiety. But the true investment merit of an asset class or a company is not what happened in the last year, but rather their DNA earnings. And this is what cyclically adjusted earnings do: is they don't just take the last year or the next year, but instead they look at a robust, more structural period, which gives you a true sense of these DNA earnings. For our cyclically adjusted earnings, we use 7 years. And on this basis, earnings are actually very attractive at current prices. So if anything, whilst our fund currently has just over 80% exposure to equities, if prices continue to fall, we're going to take this exposure higher.
Yeah, I mean, and I think that's the important thing here is if you think about it, I mean, I think Adrian put it so beautifully by saying you got to understand the DNA of a business. It's pointless to understand where earnings are going right now because you stand a 90% chance you're going to get those numbers wrong. But understanding the DNA and what the business is capable of, and understanding how they share with investors, and just the robustness of the business becomes seriously important.
It's about
and that's where the cyclical number comes in.
It's about management, of course, as well, and intangible aspects, which are always sometimes a little bit difficult to quantify. But you know, we always say on the show, though, the past is not necessarily a reflection of or a prediction of what's going to happen in the future. So how does that fit into your evaluation in your models that you use?
Well, I think that you know, whilst the future is very hard to figure out, there is a tremendous amount of information carried in the past. And you're absolutely right in saying you have to have an understanding of management, whether that's management of a country or a company. Argentina's stock market right now looks incredibly attractive, but the country's management has just got things very wrong in the last month.
Certainly done themselves a lot of reputational damage.
So you want to stay away from that. So absolutely, you've got to have both of these components, and not just is this attractively priced, but is this well managed, is it well run, and does it have good prospect? And if I can come back to the fund for a second, one of the highest equity positions that we have is an Anglo-American. An Anglo-American is really interesting to us because it represents the resource cluster, which is extremely cheap relative to the rest of the market. This is a well-run business under Cynthia Carroll. There's ongoing structural work taking place, but the way it fits in especially neatly with our investment hypothesis is that the current valuation multiples on Anglo-American are the lowest in 40 years. It hasn't been this attractively priced in 4 decades. But they sell 70% of their product, their bulk and base product is priced in SINFU markets. So these dynamic, fast-growing markets, these are the demanders of bulk and base commodity. And Anglo-American's primary output is bulk and base.
And that, of course, is one of the key fundamentals in terms of trying to evaluate various investments, is making sure that you have SINFU exposure, but perhaps by Paftoti economies.
Exactly. This is the divorce of price and sentiment. Price is saying there's no opportunity here. Sentiment is down there, and the prospects, on the other hand, we think are exceptional.
Sky's the limit, some might say. Let's look at the returns, Cobie, and run us through those.
Yeah, look at your screen. You'll see some returns here for the Canon Flexible Fund, and right at the top end of the screen, you'll see some return numbers over there. And if you just have a look at the benchmark obviously consists of 25% cash and 75% Aussie. And there you can see the all-share returns on the far right-hand side of your screen relative to the flexible fund and the returns that you're seeing over there. Obviously a young fund still, not an old fund, so you can't have a look at the very long-term track record. And at the bottom end of the screen, look at the volatility numbers. You're picking up a serious volatility benefit here for being in the Canon Flexible Fund relative to just having normal share, 100% all-share exposure. So if you want to buff on the downside and you want it to be quantitative and you want to make sure you've got serious upside and it's fundamentally cheap businesses that have been well researched, but it's a quantitative process, this is a fund that you should be looking at.
Okay, closing comments from your side, of course, within your fund space right now. So a little bit of a bias one might expect, but what is the outlook for this fund given the aggressive nature and the ability to be tactical in investments?
I think the prospects are really good, and there are 2 attributes that I'd elevate. The first is, as Cobie highlights, the volatility is substantially lower than market volatility. And in a time where you do have high volatility, investors want to steer away from that. This is a great way to essentially own the market without volatility. The second is this fund is going to do especially well where you've got extreme events. In other words, very depressed markets or exceptionally overpriced markets. In this environment, I think that there is a lot more of that to come. So I venture that this fund under Andrew's guidance is going to do extremely well.
And of course, that's Andrew Ditburner, the fund manager. Thanks so much for joining us this evening.